Stocks are falling. Trump's tariffs are shaking up the market, and even the mighty Magnificent Seven isn't safe. So, what should we, as investors, do? Well, if you're a long-term investor, moments like these might not be fun, but they do present massive opportunities. Did you know that in any 20-year period, the S&P 500 has never ended negative? Not once. That's why long-term investing in high-quality companies is a winning strategy. But here's the key. You need to have a watch list ready and do your research ahead of time. I've done countless videos discussing buy targets, and I always hear comments like, "Mark, you're never going to get those prices." Well, here we are. And those videos weren't all that long ago. So today, let's talk about 4 stocks that are prime candidates to buy the dip. The market has been rough lately, but I see it as an opportunity. Before we dive in, do me a huge favor. Smash that like button, subscribe, and let's jump into it. Back for another video. As always, I'm a CPA, not a financial advisor, so this is not financial advice. But I'm here to help guide you through this tricky market. The S&P 500 has been a whirlwind and is currently down for the year. So, what are the professionals doing? Many are diversifying into alternative investments like blue-chip art. Contemporary art has shown almost zero correlation with stocks for over 30 years. A Bank of America survey even said that by 2026, ultra-high net worth individuals could allocate 11% of their portfolios to fine art. And that's where today's sponsor, Masterworks, comes in. They've made investing in fine art accessible, already managing over $1 billion in assets with 65,000 plus active investors. Their 23 exits have all been profitable, returning over $60 million to investors. And you don't need millions or art expertise to get involved. Masterworks offerings sell out quickly, but you can skip the waitlist by using the QR code on your screen or the link in the description. Now, let's get into the stocks, starting with number 1, The Trade Desk, ticker TTD. Trade Desk is a leader in digital advertising, working with major retailers like Walmart, streamers like Roku, and even insurance companies. The best part? They're not heavily impacted by tariffs. The company has a $33 billion market cap, but is down 45% year-to-date and 55% from its 52-week highs. That's a major dip. So, what happened? The company had a mixed earnings report, missed revenue expectations, and issued weak guidance. But here's the thing. Internals are strong. They have great margins and a 95% retention rate. Weak guidance is a common theme across many companies right now due to economic uncertainty. But a 50% plus sell-off? That's overdone. Digital advertising is only going to grow, and Trade Desk is in a prime position to benefit. Revenue is projected to grow 20% annually, and earnings, while slower this year, should pick up. Right now, shares trade at a forward PE of 37, way below their 5-year average of 60. Analysts still rated a buy, with an average price target implying significant upside. Stock number 2, Novo Nordisk, ticker NVO. You've probably heard of Eli Lilly, but Novo Nordisk is one of its biggest competitors in the GLP-1 weight loss drug market. They produce Wegovy and Ozempic, 2 of the most well-known weight loss drugs. The company has a $45 billion market cap, is up only 2% this year, but is down 41% from its 52-week highs. Why the drop? Product shortages. If you don't have supply, you can't generate revenue. But that shortage issue is now resolved. And here's the exciting part. Novo is launching its own online pharmacy and slashing the price of Wegovy from $1,350 to $499 per month. Still pricey, but a big improvement. Revenue is expected to grow 20% this year and 17% next, with earnings set to grow 26% this year. It trades at a forward PE of 22.8 and a PEG ratio under 1. Very attractive. Analysts see nearly 25% upside in the next 12 months. Stock number 3, Lockheed Martin, ticker LMT. Lockheed is one of the largest defense contractors in the world. With global tensions rising, Middle East conflicts, Russia-Ukraine, US-China relations, demand for advanced military equipment is strong. Lockheed's bread and butter? The F-35 fighter jet, the most advanced combat aircraft in existence. The company has a $108 billion market cap, is down 5% year-to-date and 25% from its 52-week highs. Why? Defense stocks have been under pressure due to talks of budget cuts under the current administration. The Defense Secretary has proposed an 8% cut in military spending. But here's the thing. Politicians talk a lot, and cuts rarely happen as planned. Even if they do, Lockheed's massive backlog means revenue is already locked in for the next 6 to 8 months. Plus, if the US spends less, allies in Europe will likely pick up the slack. Lockheed trades at a forward PE of 16.9, well below its 5-year average of 19. Analysts have a price target implying 15% upside, plus a solid 3% dividend yield. And finally, stock number 4, Lam Research, ticker LRCX. Lam is a key AI play, providing high-powered semiconductor manufacturing equipment. AI demand hasn't disappeared. It's evolving. Whether companies need NVIDIA's most powerful chips or something less extreme, demand is still high, and supply chain constraints mean more infrastructure investment. Lam has a $101 billion market cap, is up 6% year-to-date, but down 32% from its highs last summer. Yes, there's risk. AI market shifts, China exposure, tariff concerns. But a 30% drop already prices in a lot of that uncertainty. The valuation is compelling. Earnings are expected to grow over 20% this year, with a forward PE of just 21, on par with the S&P 500, but with much stronger growth potential. Analysts rate it a strong buy, with nearly 30% upside expected. So, there you have it. 4 stocks that present strong buying opportunities in this market pullback. Sure, volatility isn't fun, but it creates opportunities. Don't let emotions drive your investing decisions. Let me know in the comments. Out of these 4, which one are you most interested in? And if you haven't already, show your support by hitting that like button, subscribing, and I'll see you in the next one. Take care.